Good morning, guys. What's going on? What's going on? I came across a segment on CNN. It's kind of alarming, and it's about the buy now, pay later phenomenon that's happening. Layaway, right? I remember back in the day, for those of you who don't know what that is, back when I was growing up, my mom would put like large items on layaway at like Kmart. When she would buy furniture, stuff like that, you could buy layaway items, furniture, appliances, stuff like that, pay a portion, and then once you finish pay a portion initially, and then once you finish paying it off, you can go back and pick it up. Now, which it was a horrible idea then, it's a horrible idea now. It's even worse now, because as you guys will see from this segment, people are using it for small ticket items like food and DoorDash and just things that it's a bad idea, all right? And don't do it. It's a trap. I remember last year I was doing a deal. That's one of the first times I came across this, where this young lady and her husband were buying a house, and they had a Macy's card, but underneath that Macy's card was another, I'm at the gym here, let me try to find the parking. So I remember reviewing her credit report, and the underwriter was asking me about one of the files in her credit report. I'm like, no, that's her Macy's card, and it's the same account. It's just a duplicate account. And the underwriter and I were going back and forth because she was like, Mike, no, that's not a duplicate account. It's a separate thing under Macy's. So I had to go do some research, and when I spoke to my client, she confirmed that, yeah, this is a separate kind of buy now, pay later thing that Macy's was offering. And I was like, oh. We eventually got it cleared up. Her loan got approved. She bought the house and everything. But I remember thinking to myself, these creditors, these companies, these department stores are putting people in a trap. They're offering these payment options that have huge, really high interest rates, right? That can really get some people in trouble. And I'm gonna let you watch this video so you can get an idea of what I'm talking about.
Eat now, pay later. Food delivery app DoorDash will soon allow customers to pay for their meals over 4 interest-free payments, or in full, quoting press release, at a more convenient time. But with Americans owing a record amount of debt, does this signal something more worrying about the economy? Joining us now is CEO and founder of themoneycoach.net, Lynette Calfani-Cox. Lynette, thank you so much for being with us. For those who may not be familiar, talk to us about the rise of buy now, pay later services. What are financing services like this typically used for?
Well, we've seen a huge explosion of buy now, pay later in the last several years. Certainly over the 2024 year, we saw about 90 million Americans using the NPL and spending more than $130 billion. So it's massive, it's widespread, and it's definitely here to stay. People are using it for all kinds of things. Boris, we used to see people buying big ticket items like travel or household purchases, furniture, things like that. But now we're seeing people use it for everyday items, stuff like utilities that of course have to be paid every single month without fail, as well as you just mentioned, food, just basic necessities. And so that kind of spending really does start to worry me.
Why is that?
Well, I think for a couple of reasons. We already know that Americans are, by and large, struggling as a whole. 70% of folks live paycheck to paycheck and don't even have $500 worth of savings. We have high interest rates, so there's massive amounts of credit card debt already. We have inflation surging, layoffs are on the rise, and overall, people are just struggling with tighter budgets.
I appreciate you watching this video, guys. If you're finding value in it, don't forget to like, share, and subscribe. Send it to someone you think might find it valuable. It helps with the algorithm.
But then the consumer debt that tends to get people in trouble, credit cards, auto loans, student loans, those 3 categories alone top $4 trillion. And now here comes the rise of buy now, pay later, which, in the not too distant future is going to start being from the hundreds of billions, potentially up to that $1 trillion level as well.
I guess you would not recommend me financing Chipotle burritos or Popeye's spicy chicken sandwiches with a side of lemon pepper wings. Not a good idea?
Not a good idea. Listen, I recognize, of course, that folks are struggling and that people have to make ends meet, but I do think the caution has to come into play because we see that people who have buy now, pay later, who frequently use it, they're already at risk. They're already the more vulnerable financially in society. For example, younger people under the age of 35 tend to be far bigger users of buy now, pay later rather than Gen Xers like myself or baby boomers. And that's, kind of dangerous, if I can say that word, because those younger folks have less experience overall in terms of money management and, generally speaking, lower incomes. We also know that research shows that a lot of folks who use buy now, pay later struggle later to repay it or regret those purchases. And then many of them have already had a financial setback. They've gone through a divorce, they've lost a job, they've had illness in the family. Something happened in the 12 months prior to them using buy now, pay later that kind of triggered them to need to be able to have another payment solution. So all of these things suggest that they're already financially precarious. So my advice to folks is, no, you don't really want to be, extending the payment terms for everyday purchases like the food that you need to be able to eat every day. You want to make sure that you are judicious in your use of buy now, pay later, and that you have a payment plan and that you know the terms involved for all of these things. Do you have to pay weekly or monthly? Some of them will offer you extended terms, kind of making it like a credit card. But yeah, if you stretch it out to say 24 months or so, that's going to cost you 24% and above in interest as well.
So there you have it, folks. Don't fall into that trap. All right. It's really dangerous to rack up a bunch of credit card debt, especially if you're trying to buy a house. And then when it comes time to getting approved for your mortgage, you've got to try to pay down some of that debt because your DTI is going to be too high. That's your debt to income ratio. So I hope you found value in this video, guys. Don't forget to like, share, and subscribe. Leave a comment below if you have any questions. And as always, I'm here for you. If you have any questions, reach out to me. Check out this next video. I think it'll be helpful for you.